Good evening, ladies and gentlemen. Clueless Trading, Frank. This is a quick end of the week report for week ending July 10th, 2016. I don't need to remind anyone that the past couple of weeks have been some of the most turbulent and most volatile that the markets have encountered in a long time. We are showing a split screen here, and you can see what, this very large, well, you can see that here too on the hourly chart. What you have behind you is basically the E-minis, which are up roughly about 8 points right now. Overnight Globex trading. This is a 1 hour view, and this is a daily view. We're going to go over each of them quickly. This was Brexit, where we dropped from where I thought and I had forecasted where the markets would get to that Thursday afternoon around the 21-23 level on the S&P 500. And at what point I had gone ahead and alerted that large profits should be taken off the table, that small hedges should be put in place ahead of Brexit, and then we know the whole story. The drama unfolded. We fell close to 900 points and culminated into a low on the markets at around 11 in the morning, and then at the close on Monday afternoon. Since then, the markets have not looked back. Bottom line is that through every single twist and turn in the market, Clueless Trading was there to pinpoint strategic, profitable, precision, and timely trade alerts, both on the short side and on the long side, to its extremely accurate degree. And that's the bottom line. So whether it's good, bad, or ugly markets, you can rest assured that the high caliber of precision alerts are going to keep on flowing, and that there is a high probability of making some substantial gains even through the most volatile markets that global financial players have encountered in years to come, in the past couple of years, because this was similar to the flash crash. Very similar to the flash crash, straight down. So what we're seeing here are a couple of large patterns, one of them being an ascending triangle. You can see that here on the hourly chart. We broke out of that at around 2 o'clock on Friday afternoon, right there, around 1 o'clock, I believe. And this is where we are right now. We have a downtrend line that was taken out pretty much on Friday morning, pre-market. Okay, right there. You can see that large candle. And that was on the jobs report. So here's a simple thing about the jobs report. I don't really care if the jobs report is fabricated, made up, whatever. I want to see the market's reaction to it. And if the jobs report showed a 5-digit gain and not a 6-digit gain like it did, 200 plus thousand, okay? They said the actual filtered number was more like 147,000. Whichever the case, if the job report showed a gain of less than 100,000, let's say 40,000, 50,000, 60,000, you could rest assured that the markets wouldn't have liked it one bit. The fact that we had a strong jobs report overall showed that the U.S. economy is not going to tipping into a recession right away. That provided a level of comfort across the board, and the large short unwind that has been going on since the bottom at 1981 continued, and we surged forward. This obviously has given a level of comfort to foreign global markets. And that's why we have a continuation of the rally with the futures still up 8.25 and possibly moving higher as we get towards Tuesday. The problem with traders and even professional investors are that they can never imagine that things can actually get slightly better. And more importantly, 90+% of traders and investors, in my opinion, stayed on the sidelines, completely missed out on these powerful bullish engulfing candles, which are very similar to what happened back in February when we came off this intense double bottom. And the fact is that you get these type of 3-day candle moves, like I pointed out in a few of my charts, you tend to see this initial beginnings of a surge forward. So if that's the case, if this was the 3-candle move, then we had a minor pullback, as we know, which was as I'd forecasted, because we got deep, we got seriously overbought. So the pullback was on Monday. I'm sorry, Monday was July 4th. Tuesday, and then on the 6th, we bottomed on Tuesday and didn't look back. So at this point in time, purely by looking at the technicals, it is possible that we hit the 2150 or so on the S&P 500, which is pretty much right around the corner. You're talking about 100, 150 more points. This particular pattern, which is not just a bullish engulfing expansion, but trying to look for my drawing tool here. Seems to have disappeared. Bear with. Okay, I'm back. Couldn't find my drawing tools. Let me see. Nope. That wasn't it. Whichever the case, I'll go without it this time. Let me just do this. Okay. You have and I've shown this on other charts. You have a very powerful inverse head and shoulder with a bear with me one second. Sorry about that. That's better. Okay. With the left shoulder here, our right shoulder here. All right. With the right shoulder here and the neckline up here, which we're breaking above. So many different patterns are basically falling into place to tell me that we still have juice to move higher. It's not going to endlessly move higher, but I believe that by Tuesday afternoon, we should have at least peaked till we have a nice consolidation move down into Wednesday. And looking at the date calendar, I would say that we could possibly, and I'm pulling out the date calendar here, that we could very possibly have, remember, the 15th, middle of the month, we always get turbulence, no question about it. So if we do surge ahead, we should peak sometime by Tuesday afternoon, that's the 12th, and then 13th is going to be a red day, red Wednesday, possibly pull back on Friday. Pull back on Thursday a bit, and then we surge into monthly options expiration, which is the 15th, happens to be the 15th, which is a Friday, and monthly options expiration, generally speaking, have an 80+% probability of being a bullish event. So if we see a substantial pullback or a decent consolidated pullback on the market on by Wednesday, then I would be a buyer on the weakness the following Thursday or even on Wednesday, depending on how far we pull back. It's really as simple as that. The 4-hour charts right now are showing, these are very bullish pattern here. Even the Darvis has a bottleneck, moving higher. So again, it's tough to make a real bearish case here, but a consolidated pullback, if it does happen let's say there's a fast and furious one, then the points of engagement on the futures markets would be right here, which would be around the 2100 level. So if we fall, let's say from here where we are right now, 2133 to 2100, you're talking about a 200 or so point, if not a little bit more, pullback that you could encounter. Okay, I would say here, possibly here. We want to hold this downtrend line. That's the key. Okay, so we do need to hold the 2100 line. I know it's 2100 on the E-minis, which translates into around 2105 or so on the, or 2106 on the S&P 500, but we don't necessarily need to go too far below that. At this point, we have a nice crossover of the 34 over the 50. However, the standard deviation is minimal at this point. However, if we keep on moving higher, let's say we move up to about 2143 or something like that, then the standard deviation, or the distance traveled from the upwardly rising 34 and 50-day moving averages, would be probably a standard deviation of +3 or so, maybe +4, not sure. Whichever the case, you'd have a mean reversion. What does a mean reversion mean? It simply means we'll have a consolidated pullback to alleviate overbought conditions, which means that we would mean reverse towards the moving averages, which are moving higher, and possibly test this uptrend line here, right? This would be a perfect scenario like that. Or we slip below that and test the breakout level of this downtrend line, this fat red line. But we don't want to fall below the 34 and the 50, because if we fall below here, all of a sudden, we're talking about somewhat of a mini trend change. As long as we hold, the worst case scenario is that if we hold, we better hold the 2065 level or so on the E-minis, all right? Which is roughly 2072 or so on the S&P. If we break below 2072 or 2068, 2065 on the S&P 500, on the futures, then all of a sudden you have a trend change, and that's no good. And that brings into play this type of horrific lower levels that we came off from right after Brexit. And believe me, things can happen. However, the more likely scenario going into the latter part of July is that we pull back a bit, test these lines, and then make a move from here and possibly make another high. Or if we do slip, we better hold the 2065, 2066 level, which translates into 2072 or 2073 on the S&P 500, and make a move from here. It's as simple as that. Now, couple of things I want to show. I'm leaving this section here open. These are lines that I've drawn, and it is pretty impressive, you must say, okay, that we have, it is pretty impressive that we have, that these lines are being tested. I mean, these were drawn weeks ago. This was drawn way back, these fan lines here, right? I'd drawn them. So you can clearly see here, support levels that I'd drawn, markets bounce off that. Now we're attacking this fan line here, which is also the upper end of the Darvas. And then, of course, we possibly can get up to about around this level here, which no one's talking about out there. So respect these type of, charting, which are this precise. Now, saying all that, there are multiple charts that I've shown, which are doing fantastically well. Look at the price lines. Look at the Amazons. Look what's happening with Netflix. Even Apple, the stupid Apple, I showed out, and those are up 200% from the time that I bought them on Wednesday. Sold them on Friday, right? You saw that? I said 96.44. Apple went to 96.89. And that was in the middle of the sell-off. That was in the middle of the sell-off on Tuesday before we turned around on Wednesday. Right? It's all there. Just go review it. and some of you participated in it. So there are multiple stocks that are doing what they're supposed to do, and I just want to show you something that here on the biotech index, which I think is going to be a beneficiary of the conditions in the market that we're seeing here. Despite the overbought conditions on the daily, I have a feeling that this particular range is going to be broken to the upside. It's kind of a gut feeling, but at least even if we don't break out, we still have a retest of around 290, which means that a bunch of the biotech stocks that we trade, whether it be the Regenerons, whether it be the bigger ones, okay, the AGNs, the Celgenes, that type of stock, have nice room to move forward. I'm not going to go through each individual chart because they're posted all over, through the Twitter real-time feed. All right, but this channel that I'm seeing, in my opinion, is going to be tested on the upside. The thing that you have to watch very carefully is this bottleneck that I'm seeing developing. This is a very powerful bottleneck right there. And this is one thing I noticed over the weekend. You have a bottleneck. Look at this. That's a bottleneck. I can't identify the last time I saw a bottleneck of this actual narrow, this narrow. So what does that mean? It means that there is a good possibility, that we make a move up here. Is it possible that this bottleneck breaks down and it makes a move down here? The possibility is always there. But I think this is a higher probability move, in my opinion. Similar to what happened here, where we stayed overbought for a whole bunch of weeks, back in May to June, that we can stay overbought for another couple of weeks. And the length of this move here, okay, should be replicated in the length of the move here. So in other words, we have room to move higher on the biotech index. God help us if we do have a breakout, in which case you're going to see one of those monstrous moves up towards this level, which was the previous highs and breakdown level, somewhere in the 340 to 350 range. This is important for people to realize that large-scale macro moves generally occur when no one's really watching things carefully. So what I would highly suggest is keep an eye on the IBB on the daily. At least we should get a similar pattern symmetry like that, right, off this level, at least up here. And if we do break out, we're going to have a fast and furious move all the way up into the low 300s. And that means those stocks that we trade are going to be up $10, $20, $30 from the levels that they're in right now. Multiple charts have shown, whether it's AGN or Celgene and stuff, all showing that they have a good solid $10, $15, $20 in them before they start to get really, truly overbought. So this is something interesting that I noticed. Bottlenecks don't appear too often, and when they do appear, put this out, okay? When they do appear, something big is about to take place. Looking at the weekly, I wanted to show this, highlight this. This is a large falling wedge, if you want to look at it this way. Okay, you've got two candles here moving. Generally, they last for about 3 to 5 weeks. So saying all that, we're on the second week of the candle. This candle reversal back in March lasted 1, 2, 3, 4, 5. So if this one lasts 1, 2, 3, 4, 5, we should at least test the 50-week moving average, and that is around 300. Thank you for listening.